In this video, I want to provide an overview of the material and concepts that are in Chapter 3 of your e-textbook. The learning objectives at the beginning of each one of the chapters are something you should pay attention to. They lay out the different ideas and topics, concepts that are going to be covered in that chapter. You should be able to go back after you read a chapter and be able to think back through each one of these and be able to do the things that are laid out here in these learning objectives. The beginning of a chapter provides a summary of the chapter as well. I'm going to scroll down in just a moment, but this is actually not just the beginning of a chapter, it's the beginning of one of the parts of the book. So this is about long-run economic performance in the economy. That's laid out here. It's important to pay attention to these summaries at the beginning of chapters, at the beginning of a section. So in part 2, as it says here, there are two goals. One is to think about what are the factors that affect the long-run performance in the economy, not just over the next 6 months or the next year, but over the next 5 years, the next 10 years, et cetera. Those are the things that really determine long-run living standards over time. The second part is that this is the start of our macroeconomic model that we're going to use throughout the whole semester. From this time forward, we're going to be building a single model that has different parts, right? As it says here, the model is based on the assumption that individuals, firms, and the government interact in 3 different markets: the labor market, which is in this chapter, goods market, the next chapter, chapter 4, and the asset market, chapter 7. We'll be talking about some other things in chapters 5 and 6 that deal with the long run in international economy. But these are critical chapters, and then that's going to lead us into chapter 9 ultimately, where we bring all of these markets together. So really understanding each one of these markets individually, each one of these components individually is going to be critical for your success later on in the course, or things will be really confusing at that part. So think of this as investment in your future. We're going to be building. It's cumulative throughout the entire semester, right? Everything is related in this course throughout the entire semester. So there are 6, as it says over here, 6 different sections in this chapter. The first one has to do with the production function, which is a relationship between capital and labor and overall total factor productivity and technology to output. And from that, we can get the demand for labor. And then we're going to talk about what determines the supply of labor, and bring those two together, demand and supply, to determine the price and the quantity. The price and the quantity in the labor market has to do with the real wage and the level of employment. And then we'll finish up the chapter by talking about unemployment, and then the relationship between unemployment and output. But these first 4 sections are really the critical components of this chapter in some respects. So let's just kind of go through that. So the production function, critical to understand how this works. There is an equation of the production function. Generally speaking, it just says that output is a function of, depends on the amount of capital in the economy, the amount of labor, capital stock, right? It's part of investment in that first homework and what's discussed in chapter 2, how we measure things. And A is some measure of overall productivity in the economy. Oftentimes we relate that to technology. So it's how much a given amount of capital and labor together can produce. Technology, for example, can allow the same amount of machines and people to produce more stuff, more real GDP. So that is the mathematical equation. Once we have a production function, which is going to look like this, it's going to have this kind of slope to it, right? Have diminishing marginal productivity, and the slope of that production function at any point is called the marginal product of labor, or in this case, capital. This is drawn with capital on the horizontal axis and output on the vertical axis. But we can also draw this with output on the vertical axis and labor on the horizontal axis, right? 2 dimensions, we got to keep something fixed. So we have A, we have K, we have N, and we have Y output, right? 4 different things. On a 2-dimensional graph, we can only graph 2 of those. So what it means is we've got to keep, when we draw these graphs, there are 2 of those other variables that are being held constant. In this case, with capital on this axis, output on the vertical axis, it's labor and A, total factor productivity, that's being held constant. When we have labor on this axis rather than capital, showing how much output can be produced with different amounts of labor, we're holding the capital stock and technology or total factor productivity constant. Changes in the things that we're holding constant will actually cause the curve to shift. Right? That's important to understand as we go through this chapter. So here's the marginal product of labor, and which comes from the production function with labor on the horizontal axis. It's just, we're just holding something else constant here. In this case, we're holding capital and we're holding A, or total factor productivity, constant. And with those 2 things held constant, we can graph a production function, and it's going to look something like this. You can see that's not linear. It starts out and it's it's positive, right? More labor, more output, right? That's what it means to have a positive slope, but that positive slope is getting smaller, it's getting flatter, flattening out, not as much as when we had the capital in that other graph, the previous graph. But it's getting flatter as we get more labor. That's due to what's called diminishing marginal productivity. In other words, if we graphed this graph, this is what that would look like. The fact that that is less than 1 is what leads to that diminishing marginal productivity of labor. Okay. Then we can think about shocks to the production function, and all that really means is a change in the things that we're holding constant when we draw the graph to begin with, this graph of the production function. So again, if we have labor that we're showing the relationship between labor and output on our production function, it means the capital stock, and A, the total factor of productivity, is being held constant. A supply shock in that case would mean that we're changing A or we're changing K. And when we do that, what will happen is the production function itself will shift. But notice that when the production function shifts, it still goes through the origin so that it really tilts, right? It tilts up or it tilts down. And when it does that, you can see for a given amount of labor in this case, right, the slope of this line is less than the slope of that line. So when there is a shift in the curve, the production function curve, there also is a shift or a change in the slope at every point on that production function. So 2 things happen when we actually shift the production function. And the fact that 2 things happen is actually really important. So we can then talk about the demand for labor, and we can do that in terms of the profit maximization rule for firms. They want to hire labor as long as the marginal product of that labor, the additional labor they hire, is greater than what it costs them, the real wage in this case. So they want to keep producing more as long as the marginal benefit is greater than the marginal cost. And when we apply that to the demand for labor with some assumptions that are laid out here, then what happens is we can determine how much labor they're going to hire for a given level of the wage, or the price that they have to buy the labor at, essentially, right? And so from that, we can actually get a demand curve for labor that's related directly to the marginal product of labor. Remember, the marginal product of labor is the slope of the production function. So that's related to the production function as well. So when the production function shifts, that's going to change the marginal product of labor. And that is also going to shift how much labor firms want to hire. Conceptually, the more productive the labor is because they have better technology to work with, better capital to work with, more capital to work with, it's going to make workers more productive, and they're generally going to want to hire more of them because they're more profitable for the firm. They can produce more stuff. So that's what this section is about. It's about the demand for labor and how it's related to the marginal product of labor. What happens when there's a change in the wage? Another component of this section. When the wage changes, you can think about this conceptually again. The price at which they have to pay the workers goes up. The cost to them increases, the marginal cost, and therefore they are going to cut back on their use of labor, everything else being equal. So out of that, as the real wage changes, for example, rises, there's going to be a change in the amount of labor demanded based on profit maximization. And from that, we can trace out a demand for labor curve, right? And so it turns out that the demand for labor looks just like the marginal product of labor curve, but instead of measuring marginal product of labor on the vertical axis and labor on the horizontal axis, we have the real wage measured on the vertical axis. Since for profit maximization, they're hiring up to the point at which the real wage equals the marginal product of labor. So here's what the marginal product of labor curve looks like, right? It's declining. The production function, remember, it's related to that. The slope of the production function is the marginal product of labor, MPN. As you get more labor, right, the marginal product of labor gets smaller, right? The production function, the slope gets smaller, right, as we increase the amount of labor used. So we can graph that out. And then if we, for whatever real wage there is, the profit maximizing rule is wherever the real wage is, you keep hiring more and more and more and more labor until when? Until it's just equal to the marginal product of labor, right? Where those two lines cross. If we went further and hired more workers, the marginal product of labor would be less than the real wage or the cost of that additional workers, and they would cut back. So for every given wage rate, real wage rate, the marginal product of labor curve tells us how much labor a profit maximizing firm and overall in the economy would be hired. So that we can transform then that marginal product of labor curve into a demand curve for labor. So what shifts, we're always going to be looking at what causes a curve to look the way it does, in this case, the marginal product of labor curve, and then what causes a curve to shift, right? We're going to do that over and over and over again in this course, right? This is just the first time that we have this example of how to derive a curve in the graphs that we're going to use, and then ask the question, well, what would cause a shift in that curve? In this case, it's the labor demand curve. So for a real, the question is, what causes that to shift to the right or to the left? Or in other words, what would cause a firm to want to hire more or less labor for a given real wage? And the answer to that is if there was a change in the marginal productivity of labor. In other words, if the workers are become more productive, they're going to want to hire more of them at the current real wage, and that would overall shift the the marginal product of labor curve, the labor demand curve, to the right. What would cause the marginal product of labor to increase? What would cause workers, for every hour that they work, to be more productive? Well, having more capital, having better technology, the things that shift the production function upward in this case, right? So shifts in the production function are directly tied to shifts in labor demand. Okay, and here's an example in the textbook to make that point and to go through the decision that a profit maximizing firm would make. Right, so a beneficial supply shock, something that shifts the production function upward, which is going to shift up and increase the slope of the production function at every point, which the slope of that production function is the marginal product of labor curve. It's going to increase the marginal product of labor curve, shift that to the right. And by doing that for any given real wage, if we drew a wage line across here, there would be more labor demanded. Again, it's a profit maximizing response to that increase in productivity. So we can think about the things that affect, in this case, the aggregate labor demand curve. These summary boxes in each chapter are going to be really important to pay attention to. They're going to summarize the things in particular that shift curves in our model in a kind of shorthand kind of way. Okay. In the third section in this chapter, we're going to talk about what determines whether how much people decide to work, how many hours they decide to work. Again, that's a maximization kind of question. You talk about this in intermediate microeconomics as well, but it's maximizing utility for the workers. And what they're doing is they're making a decision about how much income versus how much leisure to have. These are both goods. So a leisure is a good, something that's good, something that people would value, get utility from in economic speak. And income, it allows people to have more consumption, to buy more goods and services. But in order to have more income, you have to have less leisure. You've got to work more, right? So work is what you do after you make your decision about how much income and how much leisure you want to have, right? So that is a decision not by firms like labor demand, but by individuals, right? And it's a utility maximization decision, right? To compare the marginal benefit and the marginal cost of working an extra hour. So what are the things that are going to affect that? That's what this section of the chapter is about. So you think about what's the relationship between the real wage and how much people want to work. As it turns out, there is something called an income and a substitution effect, because we're changing the price of leisure, essentially, right? The price of how much you're giving up if you decide to work one less hour or one more hour, right? How much leisure you're going to give up or gain. And whenever you change the price of something, there's both a substitution and an income effect. So in this case, for example, you have higher real wages. It makes the decision to work less, to have more leisure, right, more expensive at the margin, because you're giving up something that you could have used to buy goods and services, right? Things that you want to consume. So the substitution effect of that works to, in this case, cause you to want to work to think about how much leisure you want to consume. As the price of leisure goes up, the real wage goes up, you generally demand less of something. In other words, as the real wage goes up, you decide you're going to work more, right? Supply more labor. On the other hand, as the real wage goes up, you don't have to work as many hours to get the same income level. And that has to do with the income effect. So in that case, as the real wage goes up, you don't need to work as many hours. It might cause you to work fewer hours to reach a certain income level. So that works in the opposite direction as the substitution effect. So we don't know theoretically which one is going to dominate. All right. So in this section, we give some examples of a pure substitution effect and what that looks like, pure income effect, what that looks like. And then when we bring them together, what's the relationship between real wages and the labor supply? Typically, we think of a supply curve as upward sloping as the price goes up. So we're generally going to think of as the real wage, which is the price of leisure, in this case, the price of working, related to working, I should say. As the price goes up, as the real wage goes up, workers supply greater amounts of labor and consume less leisure. It assumes that leisure is a normal good, and also it assumes that the substitution effect outweighs the income effect in that case. So we get an upward sloping supply of labor, right? So that's what that looks like. So we have a labor demand curve. We'll get to that in the next section, a labor supply curve, right? The labor demand curve comes from profit maximization by firms, labor supply, utility maximization by consumers. Both of them come together in the labor market. Again, here's one of those summaries. What are the things that shift the labor supply curve? Just like there are things that shift the labor demand curve, they're completely different. There are different groups in the economy involved in those decisions. And then we bring them together to find labor market equilibrium, right? Demand and supply, right? Unlike in a principles course where we're perhaps oftentimes just looking at shifts in the curves and what happens to the price and the quantity, we'll be interested in that, but it's going to be important to understand why and what decisions are being made by labor suppliers, consumers, and by labor demanders, by firms in an upper level intermediate macroeconomics course. So we'll have practice with that, on our homework for this chapter. So what we find out is that things that shift, what are the things that cause employment to change in the marketplace? Shifts in demand or shifts in supply for labor. So it's important to understand what are those things that shift those curves. Those are the things that are in those summary boxes in the previous sections of the chapter. Right. So we can have some understanding of over time what causes real wages to change in the economy, what causes employment levels to change in the economy, both in the short term and in the long term. And then we can link that, for example, to the employment report that comes out every month in the Wall Street Journal and is reported by the government. That's a short-term fluctuation, so it's not a perfect, there's not a perfect connection here, but we can look at what happens over, say, the course of 5 years or a decade and see how the economic theory here lines up with what's actually happening in the economy and what might explain changes in real wages over time or changes in employment over time. And then we can find out what the level of employment is with the level of the output at full employment associated with the level of employment. Once we figure out how many workers there are, we just go to the production function, and that tells us how much output we can get at full employment, given a certain amount of capital and given a certain amount of, say, technology or total factor productivity in the economy. So the production function, the labor market, together they tell us the real wage, the level of employment, and the full employment level of output. And then in the short run, and we'll come back to this in chapters 8 and chapter 9, we'll talk about unemployment, since in the long run, in our economic model, there really is no unemployment, right? That's hard to understand because we know that there is unemployment in the short run, but in the long run model, if the economy is going to equilibrium in the labor market, indicates that labor demand equals labor supply, and unemployment is zero, right? So we need to think about what that means in the short run, and we'll get to that later on in the course. But for now, while we're talking about the labor market, authors find it important to be able to just talk about how do we measure unemployment? What does that mean? How do we measure employment? And so we could wait until later in the course when we're talking about business cycles, deviations from the long run equilibrium, or we could talk about it now. So we talk about it now and to get an understanding of economic variables. We could have done this perhaps in chapter 2 in terms of the measurement of the economy as well. So changes in the employment status. These are some of the things that you've been reading about in the Wall Street Journal, and give some understanding about people who are going in and out of the labor force on any given month. and how that affects the economy. How long people are unemployed. So various topics around unemployment, how it's measured, and the types of what we call types of unemployment: frictional unemployment, structural unemployment, and how those things, natural rate of unemployment, how those things are related to the overall health of the economy. And then finally, in the last section of this chapter, talk about something called Okun's Law, named after a person named Arthur Okun, who first was looking at this back in the 1960s. So it's a relationship between unemployment rates and the level of output in the economy. So that's a direct linkage to the production function. And what Okun found with what's called Okun's Law is that there is a relationship that's mathematically or has been fairly consistent, right? This is the deviation of GDP away from full employment in percentage terms, and that's related to the deviation of the unemployment rate from the full employment unemployment rate with this mathematical relationship. Okay, it's a straightforward relationship. I don't really need to say anything more about that. But if we change what it means, if we change the unemployment rate, we're going to get a change. We're going to get the economy either closer to real GDP or further away, depending. So you close the GDP gap between full employment output and the actual level of output by changing the unemployment rate. Or the unemployment rate changes as you change the gap between full employment output level and the actual output level. So there's a direct relationship between the two. It's positive. It's a positive number here. And it just gives some kind of a mathematical relationship between the two. So we can actually graph that. And this comes from the work that Okun did, and then updates that information and that relationship for various years, and shows in this case, right, the rate of real GDP growth and the change in the unemployment rate. So the greater the change in the unemployment rate gets bigger, right? That means you're further and further away from real GDP, and real GDP growth is falling. When when the unemployment rate is, the change in the unemployment rate is negative, right, in percentage points, right, then it's getting smaller. So the smaller the unemployment rate, the higher is the level of GDP, the closer you are to full employment level of GDP, and the rate of real GDP growth is higher and positive, right? Hence this negative relationship between the two. So that gives you an overview of chapter 2. It's the first chapter, as we said. It's building our macroeconomic model of the whole economy. In this case, we're dealing with the labor market and the production function, and those are kind of the two foundational pieces in our model. We're going to be building on that in the next chapter and in chapters to come as well, in order to develop our full model of the macro economy.